macro currency signals.
How many ounces of silver are you holding right now? Not how many you plan to buy, not how many you used to own, not how many you wish you had when it was half the price. I'm asking about this moment because 2026 is not shaping up to be a normal year, and silver is not behaving like a normal market. Let me start with something uncomfortable. Most people still think of silver as a sleepy metal, a sidekick, a cheaper cousin, something that lags, something that follows, something that eventually moves, but only after everything else already has. That mindset is about to become very expensive. For decades, silver lived inside a box, a long, suffocating, multi-decade range. It would spike, collapse, and go nowhere in real terms. Entire generations of investors grew up believing that silver was incapable of sustaining a breakout, that every rally was temporary, that every surge would end in disappointment. But markets do something fascinating when they spend too long compressed. They don't drift into a new reality, they explode into one. And that's where we are now. When a market builds a base for years, that's one thing. When it builds a base for decades, that's something else entirely. It's pressure, structural pressure, capital misallocation pressure, monetary distortion pressure. And when that pressure finally releases, the move that follows is rarely polite. It's violent. Let's zoom out and think in terms of proportions, not headlines. When silver has broken out relative to gold after multi-year compression in the past, it didn't inch forward. It surged in compressed windows. Not 3 years, not a slow staircase, a handful of months. Why? Because repricing events don't wait for consensus, they punish it. Right now, we are barely a few months into a structural breakout phase. That matters. People are reacting as if this cycle is mature, as if we've already had the full move, as if the recent volatility signals exhaustion. But structurally, we're early. Very early. The breakout that ignited this phase didn't happen last week. It happened when silver decisively shifted its relationship versus gold after years of underperformance. That relative shift is not a small technical footnote. It is the ignition mechanism. When silver outperforms gold after a long base, that's not noise. That's capital rotating within the monetary metals space. That's the market saying something has changed under the surface. And when that shift has happened historically, the acceleration window has followed within months, not years. Now let's talk about something even more boring and even more powerful: monetary expansion. If you go back decades and compare the total money supply then versus now, the difference is not incremental, it's exponential. Currency units have multiplied, liquidity has multiplied, debt has multiplied. The denominator against which silver is priced has expanded dramatically. So ask yourself a very simple question. If the currency supply has expanded multiple times over since prior silver peaks, why would silver remain anchored to old nominal highs? It wouldn't. If silver were merely to maintain comparable purchasing power relative to previous eras, not exceed them, not enter mania territory, just maintain them, the price would not be in double digits. It wouldn't even be in low triple digits. It would be several hundred. That's not hype. That's arithmetic. Now layer on top of that the structural breakout from a range that lasted roughly half a century. Think about what that means. 50 years of compression. 50 years of back and forth inside the same valuation corridor. Markets don't sit in cages like that forever. Eventually, they reprice. And when they do, the old range stops mattering. One of the biggest mistakes investors make is anchoring to prior ceilings. They say, well, it hit this level before and failed, so it must fail again. That works until the structure changes, and when structure changes, ceilings become floors. Let's talk about speed, because that's what really unsettles people. It's not the idea of silver reaching $200 or $300 that scares most investors. It's the idea that it might happen in months, that it might happen so fast they don't have time to emotionally adjust. But history shows that once silver exits a multi-year compression and outperforms gold, it does not meander upward, it accelerates. In past cycles, silver doubled, and more, in windows measured in quarters. Not decades, not long, drawn-out expansions. Compressed, volatile, vertical repricing phases. And here's the psychological trap. Those moves are almost always interrupted by violent pullbacks, sharp drops, panic days, moments where everyone declares the top. But if you study prior acceleration phases, those pullbacks happened early and mid-cycle, not only at the end. They were part of the move, not proof against it. Volatility is not the opposite of strength in silver. It is the cost of admission. Now think about the macro backdrop we're entering in 2026. Sovereign debt levels are historically extreme. Interest expense is climbing. Central banks are trapped between inflation control and fiscal sustainability. Real yields remain fragile. Confidence in long-term currency purchasing power is not what it was decades ago. In prior cycles, policymakers had room to tighten aggressively. Today, that room is constrained by debt mathematics. Every percentage point increase in rates compounds fiscal strain. That matters for precious metals. Because when real confidence in currency stability erodes, even slightly, gold moves first. And when silver decides to move relative to gold, it amplifies. Silver is not a calm asset. It is a high beta monetary instrument. And in periods of monetary instability, high beta instruments don't gently outperform. They surge. Now let's layer in industrial demand. This isn't 1980. This isn't even 2011. Silver's industrial footprint has expanded. Renewable infrastructure, electrification, advanced electronics, data infrastructure. These are not niche sectors. They are structural growth pillars. That creates something unique. A metal that straddles monetary demand and industrial demand simultaneously. When monetary demand rises, silver responds. When industrial demand rises, silver tightens further. That dual engine didn't exist at this scale in prior cycles, so you have monetary expansion, structural breakout, relative performance shift, sovereign debt fragility, and industrial growth all aligning within the same window. And we're barely months into the breakout phase. Let me ask you again, how many ounces are you holding? Because this isn't about predicting an exact number to the dollar. It's about recognizing a regime shift when it happens. Most people miss regime shifts because they're waiting for confirmation that feels safe. They want the market to prove itself slowly. They want a year of steady gains. They want analysts to agree. They want headlines to validate. But by the time it feels safe, the asymmetry is gone. Silver does not reward late emotional comfort. It rewards early structural recognition. And here's the uncomfortable part. If silver enters a true repricing phase toward $250, $300 or beyond in 2026, it will not give polite invitations. It will move through levels people once thought impossible, pause violently, shake out weak hands, and then continue. It will look chaotic. It will look unstable. It will look too fast. And that is precisely how markets behave when correcting decades of underpricing. Now imagine silver overshoots fair value, because markets don't stop neatly at justified levels. They overshoot, they stretch, they create euphoria, and then eventually they correct. If that overshoot window happens, you don't want to be calculating how many ounces you should have bought at $40 or $60. You want to already be positioned. This is not about panic buying. It's about preparation. It's about understanding that a 50-year base does not resolve into a 10% rally. It resolves into a structural shift. The old reality was a long-term range. The new reality is being defined right now. And once the market defines the upper boundary of that new reality, it will likely do so faster than most expect. So again, I ask you, not rhetorically, but seriously, how many ounces of silver are you holding as we move deeper into 2026? Because the difference between holding enough and holding almost none could be the difference between watching a repricing event and participating in it. If silver is entering a true repricing phase in 2026, then this isn't just about charts or percentages. It's about positioning before recognition becomes universal. And recognition always lags reality. Here's something most people don't think about. Markets move in 3 stages. First, the smart capital accumulates quietly during disbelief. Second, momentum capital enters during acceleration. Third, the public piles in during euphoria. We are not in stage 3. Stage 3 doesn't look like confusion and doubt. It looks like mainstream certainty. It looks like front page coverage. It looks like taxi drivers and coworkers asking you how to buy ounces. It looks like widespread conviction that this can only go higher. We're not there. Right now, we're in that awkward zone where the move has started, but belief hasn't caught up. That's why volatility feels amplified. That's why every correction feels like the end. That's why headlines swing from new era to collapse within days. That is classic early acceleration behavior, and acceleration is where the real asymmetry lives. Let's talk about supply for a moment. Silver supply does not turn on like a faucet. It is largely a byproduct metal, meaning it is produced as a secondary output of mining other metals. That means you cannot dramatically increase silver production simply because the price rises. Supply elasticity is limited. At the same time, industrial consumption continues to grow. Renewable energy infrastructure alone absorbs significant amounts of silver. Add electrification, advanced electronics, data infrastructure expansion. The structural demand is not hypothetical. Now add investment demand into that equation. When retail and institutional flows begin shifting even modest percentages of portfolios toward physical metals, the effect on silver is disproportionately large compared to gold because the market is smaller. It is thinner, it is more sensitive. Small capital shifts create large price movements. And if confidence in traditional financial assets continues to wobble, whether due to debt concerns, inflation volatility, currency instability, or geopolitical tension, then silver becomes more than a trade. It becomes a hedge. But here's the twist. Silver is not just a hedge. It is a volatility amplifier. When fear rises moderately, gold responds. When fear rises sharply and momentum kicks in, silver often responds more aggressively. That's why the gold to silver ratio matters so much. When silver begins outperforming gold decisively after years of lagging, that's not random. That's rotation within the monetary metals complex, that's leverage flowing into the more volatile instrument. And once that rotation gains speed, it feeds on itself. Momentum attracts attention. Attention attracts capital. Capital creates more momentum. Now imagine this dynamic in a world where algorithmic trading dominates volume. Breakout levels trigger automated buying, ETF flows accelerate, options markets expand volatility, liquidity surges into a relatively small underlying market. That's how you get rapid repricing, not over decades, over quarters. The question then becomes, where does it stop? Here's the hard truth. It won't stop at a level that feels comfortable. Markets don't top when investors are cautious. They top when investors are convinced. They top when valuation discussions disappear and narratives replace analysis. We are nowhere near that emotional state. Right now, people are still skeptical. They're still anchoring to old highs. They're still saying it went up too fast. They're still expecting it to fall back into its old range. But the old range may no longer apply. Let's think through a scenario. If silver pushes through $150 decisively, skepticism will remain. If it pushes toward $200, debate intensifies. If it reaches $300 within a compressed window, disbelief transforms into urgency. And if it accelerates beyond that into $400 or higher territory, that's when headlines become breathless. That's when mainstream capital floods in. That's when risk increases. Because overshoot risk grows as participation grows. But overshoot doesn't happen at the beginning. It happens near the end. And we are still discussing whether the move is real. That's early behavior. Now let's address risk. Honestly, could silver correct sharply again? Absolutely. Could it drop 20% or 30% in days during this cycle? Yes. That's normal for this metal during acceleration phases. But sharp corrections inside a structural breakout are not the same as structural failure. Structural failure would require a decisive breakdown in relative performance versus gold, a collapse back into the old multi-decade range, and a macro reversal in monetary conditions. None of those are currently visible. Momentum, both short-term and intermediate term, is stabilizing after the recent shakeout. Sentiment was flushed, weak hands were removed. That's not a topping pattern, that's a reset pattern, and resets inside early-stage acceleration are common. Let's revisit the psychological element again because this is where most investors fail. When silver moves violently upward, people hesitate because it feels extended. When it pulls back violently, people hesitate because it feels dangerous. So they do nothing. And doing nothing during a structural repricing cycle can be just as costly as buying too late. The key isn't chasing every spike, it's building a position before the crowd arrives. And that brings us back to ounces. Physical ounces are different from paper exposure. Physical ownership removes counterparty risk, it removes timing pressure, it removes margin calls and liquidation cascades. In a world of rising financial complexity and systemic leverage, simplicity has value. An ounce in hand is final settlement. No algorithms, no derivatives, no rehypothecation. If 2026 becomes the year silver defines its new reality, whether that's $250, $300, $500, or beyond, the people who benefit most won't be the ones scrambling during the vertical phase. They'll be the ones who accumulated during disbelief. Now, let's talk about time compression. In prior cycles, once acceleration began, it lasted roughly 2 quarters before climaxing. That doesn't mean the move ends permanently after that. It means the explosive phase happens quickly. If we are only months into this breakout, the explosive window could still be ahead. And if that window opens, it will not feel calm. It will feel unstable. It will feel excessive. It will feel like it can't possibly continue. And yet history shows that's exactly when continuation often occurs. So here's the real strategic question. Are you positioning based on comfort, or are you positioning based on structure? Comfort says wait for stability. Structure says recognize regime shifts early. Comfort says it already went up too much. Structure says it just exited a 50-year base. Comfort says it could drop again. Structure says momentum remains intact. And in markets, structure usually wins. By the time comfort returns, the asymmetry is gone. One more angle to consider. Silver's market size is small relative to global capital pools. It does not take trillions of dollars to move it dramatically. Even modest reallocations from large funds can create outsized price effects. Now imagine global portfolios reallocating even 1% toward precious metals as currency risk hedges. Imagine pension funds, sovereign funds, institutional allocators seeking diversification away from traditional bond exposure. That flow, even small in percentage terms, could overwhelm available silver supply. That's how repricing events occur. They are not gradual supply-demand adjustments. They are liquidity imbalances. And liquidity imbalances resolve through price. So again, the question is not whether silver can move, it's whether you're positioned before liquidity shifts become obvious. Because when they become obvious, the price is already far higher. And when price is far higher, volatility becomes extreme. That's not the time to build a core position, that's the time to manage one. 2026 is shaping up to be a year where monetary confidence, debt sustainability, industrial demand, and structural breakouts intersect. That intersection is rare. When it happens, markets don't whisper, they roar. And the people who hear the early rumble, who pay attention to relative performance shifts, long-term base exits, monetary expansion, and capital rotation, they're the ones who act before the noise becomes deafening. So I'll ask you one more time, and this time I want you to answer it privately, honestly. If silver were to double from here, would you regret your current position size? If it tripled, would you feel underexposed? If it surged into levels that once sounded absurd, would you wish you had taken the structural signals more seriously? Because that's the real question of 2026, not what silver might do, but what you will do before it does it. And that brings us to the ending. If silver is in the early stages of defining a new valuation reality, then 2026 will not reward hesitation. It will reward preparation. The multi-decade range is behind us. The breakout is underway. Volatility is not a warning sign of collapse. It is a feature of repricing. Whether the upper boundary of this new reality lands at $250, $300, $500, or beyond, the move will likely unfold faster than most expect. And when it does, the only number that will matter to you won't be the price on the screen. It will be the number of ounces you chose to hold before the crowd understood what was happening. So as we step deeper into 2026, understand what's really in front of you. This isn't just another rally inside the same old range. It isn't just another headline spike that fades back into boredom. This is a potential regime shift, the kind that only happens after decades of compression, monetary expansion, and structural imbalance collide at the same time. When a 50-year ceiling breaks, the market doesn't politely tiptoe into a new era. It surges, it shocks, it overshoots, and only later does it settle. By the time it feels safe, the asymmetric opportunity is usually gone. Silver will not ask for permission to reprice. It will not wait for consensus. It will not move at a speed that feels comfortable. And when this cycle eventually defines its upper boundary, wherever that lands, the only question that will truly matter is not what the price reached, but how prepared you were before it got there. So look at your position honestly. Look at the macro landscape honestly. Look at the structure honestly. Because in the end, charts, ratios, and projections all boil down to one simple reality. How many ounces of silver are you holding before the world decides it wants them to?